All right, hi there. I am apparently live, so bear with me. I'm testing out some new tools here, and so you can see the title that we are going to look at Disney for a stock analysis, but I will show you. I'll get to that in a second here. I just want to make sure I'm actually live because I'm not even sure right now. It says I am, so I'm probably fine. But yeah, let me just go to my other window here. So let's take a look at GuruFocus. This is the tool that I use for the vast majority of any of my research, at least to kind of narrow down from the thousands of different companies that you might be looking at to invest in. So Disney is a company that I've been looking at this one for a while. I mean, it doesn't a company doesn't just become undervalued overnight, you know. So for me, I like to narrow down businesses that I already think are highly competitive, have a very strong place within their markets, are what I would consider safe for the long term. And if the price starts to decline a little bit, that's where I take a little bit more interest, and I can see if it hits a point where I think, you know, there's a margin of safety and I think there's room for it to grow and all of that kind of stuff, then it might be a time to actually buy or start initiating a position and to buy shares in that company. So I'm just going to get into that in a second. I want to just make sure I'm actually live here because I think I am, but I just want to see. I want to see it. So, all right, let's talk about Disney. On the main page, you can see here, this is the main page for Disney and GuruFocus. So you get a ton of information here. I'm not going to go through everything here. There's so much information, and every time I use this website, I learn something new because you can get into all the calculations, all the definitions of different things, and the terminology, and certain things you'll start to see as more valuable than others. So there's a lot of information there, but eventually you sort of come to decide what pieces of information you find more valuable, and then you can narrow down where you want to invest. So this is the main page. I mean, the profitability and growth section I like a lot, so I'm gonna circle it here a little bit. So a 9 out of 10, that's very strong, and that's what GuruFocus has given Disney here. So wide profit margins, very strong. You can see they're green right here at near the top. Some other things, I mean, you can look at the return on capital, return on assets, all of those sorts of things are very good. Growth is, I mean, it's not an astronomical, you're not looking for huge growth with Disney, but historically it does grow. I mean, it holds all kinds of amazing entertainment assets, and then you've got the theme parks and all of the merchandise, and obviously the feature films and things like that that earn a lot of money. Those things grow over time, and people spend more money on it, so there is an element of growth. However, those profit margins tell us that even in an economic downturn where people might start to try to scale back on the money they're spending on trips to Disney World, Disneyland, you know, or the money they're spending to go out to a movie at the theater, or to entertain, you know, for entertainment, this company still has lots of flexibility with its margins to, you know, not charge so much, potentially offer discounts, or spend less on certain areas where it's developing its product. So there's room. You'll see a huge difference when you look at businesses where the margins are very tight. Those are companies that tend to compete on price a lot, so you might see that in retailers, where shoppers and their customers really are just looking for the cheapest price on product, and there's no room for error there. If there's a misstep, they can't just discount their product to attract more customers. They need to find more creative ways to attract customers. So, but Disney is not like that. There are wide profit margins that tell us that this product is very unique, and you know that just by watching the films, right? You can't just go to any other studio and have a Star Wars movie made, or think back to any other film franchise that Disney owns. I mean, that's pretty unique. So people will pay to see that specific thing. So anyway, I'll leave that at that. There's obviously far more to it. It is very interesting. But near the top here, you can see some other valuation bars right in this little square rectangle that I drew. They call it the valuation box. So I'll just go back to that. And that was the explanation. So click on that to get the explanation of what it is. But according to all of these different sets of criteria and theories, or whatever you want to call it, that would be the value that you can assign to Disney, the intrinsic value. So that's not the market value. The market value is $116.44. So that's just the quoted stock price. If you want to buy shares, that's the price you'll pay right now. But if you look at the intrinsic values according to different calculations, then you'll get different values. So here you have a discounted cash flow, earnings based, which is a bit higher. So this is giving it a value of $177.95. So it's a little bit smaller, but you can see it at the top, which is more than today's quoted market price. So you would think in there, if you are investing based on that calculation as your criteria, then this is undervalued. So there is a DCF tab right here. I'll circle it, where you can actually get into the discounted cash flow calculation and see if the parameters are actually correct, because I always have to go in and look at what numbers are they actually using to come up with this calculation. So here it is, $177.95 as the intrinsic value that the DCF calculator assigns to Disney. But it's made some big assumptions. So I'm going to scroll here. And so here you have the inputs. And a few of these things are very important. So, you know, if you're not careful with the numbers that go into it, you can come up with any value you want if you put the wrong, or if you put certain numbers in there. But the assumption it's made is that it's past 10 years earnings growth number, which is down here, 15.6% per year. It's just assuming that it's going to be able to carry on that growth for the next 10 years. And obviously, you really have to think about that. There's no right or wrong answer with that, except that you need to take a lot of time to think about it and to research the company, research the marketplace, right? Netflix and other streaming services. This is a quickly evolving marketplace, so will Disney be able to keep up that kind of growth? No one can be sure. I'm not sure. I have no idea. But one of the best indicators, and one of the most important things that you should probably factor in, is its past consistency. How long has it been able to maintain that growth? How has it handled downturns in the market and all that kind of stuff? which gives us the predictability. So this is a whole other thing that's calculated by GuruFocus. I recommend you go and read up on that. But Disney overall is a fairly predictable company historically for its earnings, its revenue, and its growth, all of that. It is a fairly predictable company compared to most other companies. So maybe 15.6% is an okay growth rate to assume in this calculation. So there's a lot of uncertainty in there, right? We keep talking about making assumptions, uncertainty. We have no idea what's going to happen in the future. Well, that's where we need our margin of safety. So traditionally, if you want to put it that way, Ben Graham, Warren Buffett, they talk about a margin of safety of 50% at least. So if they think that the intrinsic value of a stock is $200, they would rather not pay more than $100 per share for that business, because you know, what if they're wrong? There's all kinds of things that could be wrong about that calculation. So anyway, that's your margin of safety, and here maybe you think you're more comfortable with a margin of safety of 34% or in that neighborhood, and you can change that again by changing, let's say, like the discount rate, right? So if you think that you can get 10% in the marketplace right now on just an index fund, for example, then maybe that's your discount rate. I think even that's a bit high in today's marketplace, but because I mean, there's an opportunity cost no matter what you do. Even if you just hold cash, inflation and missed opportunities also cost you in investing. So anyways, overall, the S&P 500 will return somewhere around 11%, I think, per year historically. So that's where the discount rate can be 10 to 12%, which gives you the margin of safety in comparison to what other things you could be investing in. So according to all of this, the share price for Disney right now is still undervalued. Granted, we can go back to this chart up here. It might have been better for you to buy in this range where it was below all-time highs, or close to all-time highs, I think. Let me just make sure. Yeah, I think we're pretty close to all-time highs for Disney's share price. However, I'm looking at the price to earnings ratio here, 13.95. I mean, this is not an overpriced company. I don't think anybody could make that argument, even if it is at all-time highs, based on all the things that we've talked about. So I think I should just leave it at that, because I could go on and on about different features and different calculations within GuruFocus, but that's the DCF calculator for Disney. I like Disney very much. I am a shareholder in Disney, and that's one that I plan to hold for, you know, years to come. It's a long-term holding for me, for all sorts of other reasons as well. But anyways, hope you enjoyed this video, and have a wonderful day. Take care.